Though the analysis/commentary industry at large likes to pretend to be bullish all the time, the reality is markets can be fundamentally bearish. Seasonal analysis can also be used to show us the bullishness or bearishness of livestock futures spreads, given these markets are non-storable. Live cattle spreads have been bearish for a long time, and seasonal patterns suggest they should stay that way for the foreseeable future. I learned a long time ago that if one wanted to make a living writing commentary, analyzing, or talking about markets, then they had to always be bullish. We see it every day with the talking heads pretending to be analysts, regardless of market sector. As most of you know, I did not follow that lesson, preferring instead to talk about market reality over the course of the decades. Sometimes that means we have to be bearish, if that's what the market is telling us. I've been reminded of this frequently recently, as nearly everyone we see on television or hear on radio wants to be bullish live cattle, LEM 22. I don't know why, for the market is showing no sign this is the case. From a technical point of view, I suppose, one could make a bit more bullish argument following the recent rally in live cattle futures. To go along with this, recent CFTC commitments of traders reports have shown non-commercial traders to be slowly adding to their net long futures position, though it was still a rather unimpressive 51,842 contracts in last Friday's report, legacy, futures only. But what does Newsom's market rule number 6 tell us? Fundamentals win in the end, and live cattle fundamentals remain bearish. Taking a look at the seasonal weekly close-only chart for the August-October live cattle futures spread clearly shows this to be the case. The 2022 spread, green line, has consistently been running below previous 5-year low weekly closes, blue line. I hear your questions out there. What about the recent strength of August versus October? Take another look at the chart. When fundamentals are at their weakest, again the blue line, the spread tends to firm from mid-April through early June. This doesn't mean the market has suddenly grown bullish, it's just a seasonal pattern. Or in other words, it is what it is. Wednesday's close had the August-October spread at $5.95, as compared to this week's previous 5-year low weekly close of $5.575. That's still bearish fundamentally, regardless of the imaginary picture so many other commentators try to create. I've chosen to look at the August-October spread for another reason as well. This being April cattle on feed week, there is a lot of chatter about what the numbers will be this coming Friday. A few things to keep in mind. The on-feed number is for April 1st, meaning the market has long ago factored in the size. The April-June futures spread finished March at $3.10, putting it in neutral to bearish territory. The June-August spread closed March at $1.05, below its previous 5-year low of 90 cents. Meaning on-feed won't likely be as large as previous numbers, but still leaning bearish. Marketing are for March. Meaning we can use the neutral to bearish April-June spread as a guide. Placements are for March as well. But we want to look at the August-October spread, as that's when those cattle will be coming out. The last week of February saw the August-October close at $5.65, with the last week of March showing $7.025. With August losing ground to October while cattle were being placed during March, it tells us placements continued to grow. Which fits with the drought across the U.S. Central and Southern Plains, pushing cattle out of pastures and off wheat into feed yards. It's okay to be bullish when the market tells us it's right. By that same logic, there is no harm in being bearish when market fundamentals are bearish.